both the monthly chart and the daily chart are saying we should go to 2660 to 2730. So like 2700 is kind of like right in the middle. Gold should run to 2700. And that is just based on this initial run up from the bear market bottom to its huge multi-year consolidation, which this is just really just a big bull flag pattern at the halfway point. And the 100% measured move should bring us up to 2700. So, I mean, I've been talking about this for months. I'm like, this chart has been pointing to this for actually a couple of years. So none of this is a surprise. We've been watching it run. I own a lot of physical metal, only physical metals. I will get into miners at some point, probably next year when the perfect storm brews.
As the financial world turns its attention to the precious metals market, gold finds itself at a critical juncture. Recent analyses from industry experts paint a complex picture of potential price movements in the coming months. The Heraeus report highlights a concerning trend for gold investors. Since 2017, September has consistently yielded negative returns for the yellow metal. This pattern, attributed to traders returning from their summer break, suggests a potential pullback may be on the horizon. However, not all indicators point downward. The Federal Reserve's upcoming decision on interest rates, following the Jackson Hole Conference held on August 20th, could serve as a significant catalyst for gold prices. Analysts widely anticipate a rate cut by the end of the month, with some speculating on the magnitude of the reduction. A more significant cut is expected to weaken the US dollar, potentially driving gold prices higher. Yet the market's efficiency in pricing this information creates uncertainty. With gold holding steady at around $2,500 per ounce over the past 2 weeks, some experts believe the potential rate cut may already be factored into the current price. Adding another perspective, technical analyst Vermeulen offers a bullish outlook based on Fibonacci extension patterns. His daily and monthly charts analysis suggests a target range of $2,660 to $2,733 for gold, focusing on the $2,700 level. Vermeulen's methodology relies on the principle that if the price reaches the 618% Fibonacci extension level and briefly pauses, it's likely to continue to the 100% measured move. Vermeulen's confidence in gold's prospects is reflected in his personal investment strategy, which includes holding physical gold and considering future investments in gold mining stocks. Please tune in for our exploration of ChrisVermeulen's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
So Fibonacci extension is by far, other than the 5-day and the 20-day, Fibonacci extension is the best tool for predicting where price is going. And I have a couple key rules, which I'll show you. So let's just go to the daily chart. Let's look at the daily chart first for where gold should be going. This is the last run up and the last bull flag pattern. Fibonacci extension. So a lot of people use a retracement, which is telling you how much back, like where it could pull back to once it starts. Fibonacci extension is saying based on the run up and the little bit of a pause, how much further can it go if it has another leg up? So Fibonacci extension, you more or less, let me just make sure I get the low here. We take the low, we take the high, and then we take this low and we just drag it and carry it forward. And so the way it works, and I only have 2 lines set up on here. Most people will have all kinds of lines. The indicator naturally gives you a bunch. You just want the 618 extension, and then you want the 1, which is 100% measured move. So this run up is the same as this run up. So it's the same percentage-wise, the same kind of momentum move. And my general rule is if it hits the 618 and pauses and pulls back a little bit, only has to do it for a bar or two, then you're almost always going up to hit that 100% measured move. And this works with almost all asset classes. This works with everything that I pretty much use. So we have just hit that 618. It's been taking a pause. This is the daily chart. So it's been pausing for about a week or so. And now it looks like it's primed and ready to go up to 2733. So that's just based on this year's price action. What's really cool is if we go back and look at a totally different time frame, and I look at the Fibonacci extension of this overall bull flag from the low to this massive run up and then down to this low, and I carry it forward, it gives us kind of another set. Now we could go from a few different levels here. We could either take the ultimate low. Usually I draw them all in here. We can grab a few different levels, but what we can see here is both the monthly chart and the daily chart are saying we should go to 2660 to 2730. So like 2700 is kind of like right in the middle. Um, Gold should run to 2700. And that is just based on this initial run up from the bear market bottom to its huge multi-year consolidation, which this is just really just a big bull flag pattern at the halfway point. And the 100% measured move should bring us up to 2700. So, I mean, I've been talking about this for months. I'm like, this chart has been pointing to this for actually a couple of years. So none of this is a surprise. We've been watching it run. I own a lot of physical metal, only physical metals. I will get into miners at some point, probably next year when the perfect storm brews for that. But right now, I mean, 2,700 for gold is the upside. Once we hit that level, it's like, game off, like whatever, anything can happen after that. We could go into a pretty big correction, because I do think at that point, the stock market itself will actually have a correction. Just like in 2008, we had a multi-year pause, and then everybody rallied into gold just before the 2008 financial crisis. We just had a multi-year pause. Everybody's running into gold just before the next crisis, and then gold pulled back about 34%. So gold could get up here, but it might end up pulling back and having a significant correction before it has that next like kind of parabolic multi-year run where it goes up to 35 or 5,000 or wherever it's going to go. But super bullish on gold short term, really bullish on gold long term.
The gold market is experiencing a notable shift in dynamics, with speculative activity reaching new heights while traditional demand centers show signs of cooling. This dichotomy presents a complex picture for investors and analysts alike. In the United States, the COMEX gold futures and options market, operated by the CME Derivatives Exchange in New York, has seen a significant uptick in bullish sentiment. Managed money traders have increased their net long positions to levels not seen in 4 years, now at 155% above the long-term average. This surge in speculative interest coincides with gold prices breaking fresh records, highlighting the growing optimism among sure market participants. Traditionally a significant player in the gold market, China is showing signs of reduced demand. For 7 consecutive sessions, gold prices in China have traded below the spot prices in London, indicating dwindling interest in gold in the world's largest market. This contrasts with the high premiums observed in Shanghai before the global price surge last autumn. Vermeulen advises a cautious gold investment strategy, prioritizing consistent small gains and risk management over high-risk bets. His approach emphasizes a high win rate, manageable losses, and proper asset allocation to navigate market volatility and achieve steady returns. Let's get back to the interview.
You need to understand investing, making money isn't about putting on more trades. It's about picking smart decisions, smart trades, a strategy that works in the current market conditions. Is waiting for that proper trade setup, not hunting and looking for one because you think you need to be in one. Because once you start looking for one, you will find one. Your brain will eventually say, that's good enough. You have to gone through like dozens of charts. You're like, this one I'll pick. This one seems like all right. And those are never good. You need to really let the market set up for you, create the opportunity, get in and trade. I mean, the strategy I have evolves. Like the strategy I use actually is multiple strategies. So as the stock market goes through different stages and phases and market conditions with volatility, the strategy we use actually changes. We'll trade differently. We use different ETFs, inverse or long, whatever it is. And so that's what's really important is you can't just use one strategy through all market conditions. There's 4 market conditions. Typically, a strategy will work in one market condition. So you need 4 strategies in your one strategy to like be able to trade and make money all the time. Most people don't do that. Options are a great way to do that. We do. I don't do options, but I have an options guy who helps that, and you're big into options as well. And it's all about selling and writing options and doing all these, more complex trades. But you can have very good winning odds and do very well, and just kind of hammer out winning trade after winning trade. And you can find a strategy with options that works in every market condition, which is awesome. So you just need to pick what style you are. And a lot of people think they need to buy the dip, or they need to like sell near the market top. And unfortunately, it's hard to explain it to people. It's not about trying to catch the bottom and buy on the dips. It's about identifying a longer term trend and then moving into the trade with the proper asset allocation, so you have the right volatility. A lot of people will move into one stock or one crazy ETF, like a triple leverage something, because they love the asset or something and they want to make a ton of money, and it backfires and they're like licking their wounds for months or years. It takes forever to make money back if it goes against them. I like the slow kind of progress. I'd rather take a whole bunch of first, second base hits and almost win every trade. And when it goes against us, it's a small little nick. And we're like, all right, well, we'll make it up in the next trade or two. And then we'll be right back to new all-time highs. So I trade it in a very conservative way and I manage risk. And as soon as I say that, everybody always thinks, well, you can't make much money. Like it's conservative. But the way that I do it is we actually generate, 2 to 3 times the returns of the stock market. If you were to do the buy and hold, like we average about 14, 15% a year, doing like 5 to 12 trades a year, because we just wait for these waves, these nice, strong trends to happen in the market. And then we move into the trade and we catch the trend. And when it starts to weaken, we move out. And people all the time, they're like, why are we sitting in cash? Like, why aren't we in a trade? Like I'm paying you a subscription fee. Like people will get upset. I'm like, I'm protecting your capital because there isn't a good trade, particularly right now. And we'll get into something, but people think they have to be doing something. And that's where like the whole advisor side of things, like the SEC, like more or less has a rule. The advisor can't just put you in cash, because then the advisor's not doing anything and they're not really allowed to charge for not doing anything. So the advisors all do the same thing. Let's dump everybody into like a 60-40 split. Some things will do well, other things will tank, but they can always say, hey, but look at, you're doing okay over here, even though you're getting slaughtered over there. But nobody gets in trouble on the financial advisor side, because everybody who uses an advisor, and all the advisors do the same thing. So they can't really get in trouble, because that's just the norm, right? What's wrong is wrong. Doesn't matter if everybody's doing it, and what's right is right, even if no one's doing it. And I consider the strategy that I do, which is like asset revesting, like no one really does it the way that I do. And I believe it's the right way. It's simple. It's consistent. We manage our risk. We can make money in all market conditions. It's super slow and boring, which is awesome. But people don't like super slow and boring. It's like blows my mind. I'm like, it's crazy. It's so frustrating.
Investors find themselves at a critical crossroads as the precious metals market navigates through these evolving dynamics. The interplay between speculative fervor in Western markets and shifting demand patterns in traditional strongholds like China adds complexity to any investment decision. With potential catalysts like interest rate decisions and technical indicators pointing in different directions, the path forward for gold remains uncertain yet full of possibilities. In such a volatile environment, a disciplined investment approach focused on risk management and steady gains may offer the most reliable strategy for navigating the turbulence ahead. Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.